All right, everybody, welcome back. In part one, I broke down at a high level what a multifamily syndication is, why it matters, and why most accredited investors have never been offered one. If you missed that, go back and watch that first. The link is right here. Today, I'm gonna be getting into the math, what the actual return structure looks like, the tax layer that changes the entire equation for high earners, how to know if you qualify to invest, and I'm gonna give you a quick 5-point framework that can help you vet a deal before you ever write a check. So let's dive straight into it. Now, most people evaluate an investment on one number, the return, the yield, and that's, hey, it's understandable. But in multifamily syndications, there are actually two layers of return that are happening at the same time, and most investors only ever really see the first one. Layer one is cash flow. This is the quarterly distribution that's hitting your account while you own the asset. Now, preferred returns on quality deals run anywhere between 6 to 8% annually before the general partner or GP participates in any profit. Now, after that preferred return is hit, cash flow and back-end equity typically split 70% to the LP and 30% to the GP. So on a $100,000 investment at a 7% preferred return, you're looking at $7,000 a year in distributions paid quarterly from a cash flowing asset that you do not actively manage whatsoever. And on the back end, when the asset sells, typically in year 3 to 7, a well-performing deal that targets a 15% IRR could return $175,000 to $200,000 on that same $100,000 investment. And that back-end gain is usually taxed as long-term capital gains, not as ordinary income. So that's layer number one, and most people stop there. But layer number two is where it gets really, really interesting. Now, when the GP acquires the asset, most of the time, they hire a third-party company and they commission what's called a cost segregation study. And what that does is it accelerates the depreciation schedule on the property. By breaking down components of the building into shorter depreciation timelines, you're able to take more of the tax deductions earlier. And that depreciation flows through to your K1 at tax time as a paper loss. So here's what that looks like theoretically in practice. You invested $100,000. You received $7,000 in cash flow distributions this year. That's real cash in your bank account. But your K1 shows a paper loss because of accelerated depreciation, which means those distributions may effectively be tax sheltered. You got paid and reduced your taxable income at the same time. Now, for passive investors who are using those paper losses to offset passive income from other sources, that tax layer fundamentally changes the after-tax return profile of the investment. Now you're not just earning a return, you're earning a tax-advantaged return on a professionally managed cash flowing asset. And that combination, quarterly income, back-end depreciation, and the tax efficiency layer is the very reason why institutional money has never left this space. And it's why the investors who understand this structure keep coming back to it. So who can actually do this? How do you know if you qualify, and how do you make sure that you're doing it right and investing in the right deals? Well, to invest in a real estate syndication, you typically do need to be an accredited investor. And under the current SEC rules, what that means is a couple of things. One, you earn over $200,000 as an individual or $300,000 jointly. You've done so in the last 2 years and expect that to continue. Or you have a net worth of at least $1 million, not including your primary residence. So if you're a surgeon, you're an attorney, you're a tech executive, you're a business owner, founder who's had a liquidity event, you very likely already qualified. You're just not being offered these types of deals. And that's the advisor gap that I talked about in part 1. Now, assuming you qualify and you're able to find a deal worth evaluating, here's a 5-point framework for vetting the deal that I would typically use. Now, it starts with the operator track record. I have a high value that the team is more important than the deal. Who's actually running the deal? How many deals have they closed? What happened to their portfolio from 2022 to 2024 during a real stress period in multifamily? See, an operator with a track record through a difficult market is a fundamentally different conversation than one without it. So you really want to start by making sure that the operator has the experience and track record. The second thing that I want to look at is market selection. Where's the asset located? It might have really good fundamentals on paper, but if the market is not there to support it, then the deal could likely underperform. Things like population, net migration gains, that type of data really matters. High rent growth markets have a very different supply and demand dynamic than markets that are losing residents. So you really do want to know which one you're buying into. The third thing that I would really want to pay attention to in a deal is the debt structure. Are they using fixed rate or floating rate debt? Are they using bridge debt or agency financing? Is it recourse or non-recourse, right? Floating rate debt is what sank a lot of 2021 vintage deals when rates moved up really fast in 2022 and 2023. So you want to ask about the debt before you invest. The fourth thing is the PPM, the private placement memorandum. Read the private placement memorandum. I know it's a long legal document that is probably the last thing that you want to spend time reading, but you really want to read the PPM before you invest. You want to specifically understand the waterfall structure. You want to understand the preferred return terms. And you want to be able to see what the downside scenarios look like. The PPM should disclose a lot of, or as many of the risks involved in investing in that particular deal as possible. And one of the most important things you can do before investing is understand the risk and make sure you're comfortable with it before you just get excited about the upside and the yield. The last thing that I'm really a stickler on is alignment of interest. Does the GP have their own capital in the deal? Are they actually investing in the deal? Because if they're not taking real risk alongside of you, then that's something that's worth paying attention to. So understand, this investing strategy is not passive like wire your money, set it and forget it. It's passive like you do your homework once. You place capital with a qualified operator and then you get out of the way and you let the thing work. And that's the whole job of investing as a limited partner in real estate syndications. Now, multifamily syndications are not a loophole. They're not sexy. They're not exotic. They're the same vehicle that institutions have used to build and protect wealth in real estate for over 40 years. And they're fully accessible to any accredited investor who knows what to look for. So if you want to go deeper on this stuff, you specifically want to see how this approach stacks alongside of oil and gas investing and private credit and other private alts as part of a broader alternative investing strategy, then smash the subscribe button. That's what we talk about here. Own the Exit's the #1 podcast and channel for entrepreneurs and business owners who are educating themselves and investing in private alts.